Hi, welcome to Finance Flashcard. In this video, we will look at what is mutual fund and what are the advantages that we have when we invest in mutual fund. Alongside, we will also look at what are the different types of mutual funds. So let's get started with the video and I hope you enjoy the video. Now, the very first thing is what is mutual fund? So, in simple definition, mutual fund are investment vehicles that pool money from multiple investors to purchase a diversified portfolio of stock, bonds, and other security. Now, let's understand this with an example. Suppose there are five investors who wants to invest 100 rupees each, and there is one stock which is currently trading at rupees 500. Now individuals cannot buy this 500 stock standalone because they have only 100 rupees, but what they can do, they can club all those 100 rupees from five investors and then they can invest those 500 rupees to buy that one stock in the share, and each one will get 20% of that stock. Now what is the benefit of having this pool fund? Since you cannot afford to buy one single stock, now with the help of other investors you pooled your money and now you can invest your fund in a stock that individually you cannot afford. The other way to think is, suppose you have 1000 rupees and but you don't want to put that 1000 rupees in 500 stock by buying two stocks. So what you did buy stocks which are different and was trading at rupees 100, 200 and 300. Let's say there was one stock X which was trading at rupees 100 and there was another which was trading at 200 and there was another which was also trading at 300. Now instead of investing those 1000 rupees in one share, what you did was you diversified your portfolio by buying three different stock by investing 300, 200 and 100 rupees subsequently. Now what is the benefit of this? Now instead of buying just one stock, you buy different mixtures of stock, and in this portfolio you diversified using different stock. So as we say, diversification is one of the major benefit of having a mutual fund in our portfolio, but there are other benefit of having mutual fund also, and these are the four main reasons that you should have portfolio consisting of mutual fund. The very first one is affordability. Now some of the SIP even start with rupees 100. Now 100 is a very low amount and the investment requirement is very low. So even an individual who cannot invest in largest company which whose stock might be trading at 500 rupees, 600 rupees or even 1000 rupees can invest in mutual fund with even 100 rupees and they can start investing. And we understand the diversification aspect of having mutual fund in your portfolio. And diversification spread your risk by investing in various security. Suppose there are in your portfolio there are three or four different mutual funds. One is having debt funds, one is having equity funds. So you are already diversifying your portfolio in equity and debt, hence you are buying a different basket of fruit, and your basket consists of different fruit which gives you benefit of risk and which reduces your risk. The third one is your liquidity. Now what does liquidity means here? Liquidity is your ability to buy and sell share on business day. Now you can liquidate your mutual fund whenever you want money. There is no restrictions on whether you cannot sell those mutual fund at some point of time. There is always liquidity in mutual fund. The fourth one is your professional management. Now those mutual funds are managed by experts at optimal for optimal investment. Now what does professionals here mean? Those portfolio manager who has expertise of 10 years, 15 years manage your fund, which is also known as passive investing. You are not actively investing in a stock market. You are not always looking for the stock and their market corrections, or you are not keeping yourself updated every time, but rather you are investing passively, which means that these professional management will take care of all the research and details. Now let's look at a quick summary about what is mutual fund and what are the advantages of mutual fund. Now mutual funds are a basket of stock or bonds or investable securities. And what is the benefit of having mutual funds? The very first one is your investor contribution. These funds are pooled from different individuals to give benefit of those individuals who cannot afford to invest in a company, or who wants to invest in different companies with smaller amount of money. The second one is your diversification. Now mutual fund gives diversification benefit. You can diversify your portfolio using small amount. And the third one is your professional management. These funds are managed by professionals who are passively investing your money, which means you do not have to actively look for the market correction and market data. These figures will be taken care of by the managers who are managing your portfolio. Of course, they take little bit of charge. Those charges are already mentioned in the fund. Now we will look at what are the different types of mutual fund that exist in the market. So whenever you look at a scheme, you have a broader idea that where you are investing your money into. Now the types of mutual fund are broadly categorized into two types, which is debt and equity. Debt means you are giving loan to company, and equity means that you are having shares of company or ownership in a company. Now what are the different types of equity funds? The very first one is your large cap, which means investing your fund into large market cap company. Similarly, we have medium cap and we have a small cap, and then we have multi cap. Multi cap are those funds in which few companies consist of large cap industries, some of medium capital, and some will have a small cap companies. Now the fifth one is your ELSS. Now ELSS is broadly used for tax saving purpose, and it has 3 years of lock-in period. The next type is your dividend yield. This type of scheme broadly invest your fund in those company that pay good amount of dividend. Then we have sectors mutual fund based on sector. Suppose there is a sector of steel industries or infrastructure. So if you are investing in sectorial fund, you can expect that your fund manager will invest your fund into broader sectors. Then we have contra equity fund, which means that your fund will be allocated to those type of stock that are currently undervalued or have a very different market perspective. And then we have value investing. Now these are the different types of equity funds. Now, as I said, debt funds are type of loan to the company. If you invest in debt fund, which means that you are giving loan to the company. Now we all know that there is a duration for loan. Now it depends on for how much amount of time you want to give company your fund. There will be low duration scheme, there will be medium duration scheme, there will be dynamic bonds where the bonds will fluctuate with respect to time. If the company need fund for longer period, then your money will be invested for longer time. Then we have credit risk, which means that it invests in companies based on their credit risk. Then we have liquid risk, which means that it invest your funds in those companies that have high liquidity or low liquidity based on the criteria picked by the fund manager. And then we have ultra short debt funds, those marketable security which have a time span of less than 91 days are known as ultra short debt funds. Now in the subsequent videos, we will try to understand each and every different type of mutual funds, and I will also be putting up all those necessary details about each category of fund, and will also guide you whether this particular fund is good for you or not based on their risk management, based on their riskometer, and based on their criteria for picking the companies. So you can have a better understanding that if you're picking a mutual fund, whether it is right or not for you. So do check out the next videos for more, and if you like the video, do subscribe to the channel. Thank you.